In 1932, a farmer named Aurelio Mendoza in the highlands of Jalisco lost everything. His coffee crop failed. The export price collapsed to a third of what it had been 3 years earlier. The regional bank that had financed his seed purchase called the loan. He had 4 children, a wife, 6 acres of rocky land, and 11 pesos in a clay jar buried under the kitchen floor. By 1938, he had rebuilt a functioning household economy, fed his family through 6 consecutive difficult years, sent 2 children to the village school, and begun lending small amounts to 3 neighboring families at terms that kept them solvent rather than driving them into the ground. He never left Jalisco. He never found new work. He used 20 methods that every Latin American family of that generation knew by necessity, and that no economics textbook written after 1950 bothered to include, because by then the assumption was that governments and banks would handle the next crisis. Number 14 on this list kept more Latin American families fed during the Depression than every government relief program on the continent combined. Number 8 was declared illegal in 4 countries, specifically because it worked too well and bypassed the institutions that needed people to stay dependent on them. And number 1 is the reason some families recovered from the Depression in 3 years, while their neighbors were still struggling in 1945. These 20 methods were not emergency measures. They were a complete alternative economy that operated in parallel to the formal system and outperformed it every time the formal system collapsed. Before we start, subscribe, because what you are about to learn is worth more than any economics degree that left this out of the curriculum on purpose. Number 20. Reading the land before the market. Every Latin American farming family that survived the Depression intact had one skill that no textbook quantifies: the ability to read their land as a financial instrument rather than just a production unit. This means knowing not just what the land could grow, but what combination of crops, timing, and soil management would generate the most resilient household income across a full calendar year, regardless of what external prices did. A family in 1932 Michoacán that understood their land well enough to rotate between corn for consumption, beans for protein and nitrogen, squash for fast calories, and a small cash crop of chilies or tomatoes was running a diversified portfolio that no Depression-era bank product could match in stability. The Depression revealed a brutal truth. Families that grew one cash crop for export were devastated. Families that grew a mix for themselves first and sold the surplus second survived. In 1933, corn prices in Mexico fell 60%. Families that grew corn to sell lost 60% of their income. Families that grew corn to eat lost nothing because they were not selling it. Your great-grandfather's insistence on growing food first was not stubbornness. It was the most sophisticated risk management strategy available to him. Number 19. The emergency seed reserve. The families that recovered fastest from the Depression were not the ones with the most land or the most cash. They were the ones with the deepest seed reserves and the clearest knowledge of how to use them under pressure. In drought years, in flood years, in years when the export market collapsed and there was no point planting for sale, the family with 3 years of seed stock stored in dry clay pots had options that the family who bought seeds each season from the local merchant did not. In 1934 drought-affected Oaxaca, seed was more valuable than cash. A family that could offer planting stock to neighbors who had lost their reserves was earning social credit, labor obligations, and food payments that sustained them through a growing season with no commercial income. The Depression made visible what prosperity had hidden. The family that controls its own seed controls its own future. Multinational agriculture companies understood this completely when they began engineering sterile seeds in the 1970 seconds. A farmer who cannot save seeds must buy them every year. Aurelio Mendoza's clay jars were not poverty. They were a 3-year insurance policy that no company would have sold him at any price. Number 18. The communal grinding mill cooperative. In Depression-era Latin America, the cost of processing basic foods, grinding corn into masa, pressing sugarcane, milling wheat, consumed a significant portion of household income for families who had to pay commercial millers for the service. Communities that organized cooperative ownership of a grinding mill eliminated this cost entirely, and in doing so, freed up cash for other survival needs. In 1931, Highland, Guatemala, a community of 40 families that pooled 4 pesos each to purchase a shared hand mill reduced their collective food processing costs by the equivalent of 80 pesos annually. Money that stayed inside the community instead of flowing to a commercial operator. The cooperative mill also created a gathering point where food security information circulated. Who had surplus, who was short, who needed labor, who could offer it. The Depression accelerated cooperative formation across Latin America precisely because the cash economy had failed, and collective ownership of productive tools was the only viable alternative. The cooperative movement that emerged from this period was so economically effective that it was systematically discouraged by governments and lending institutions through the 1942nd and 1952nd because it made too many communities genuinely self-sufficient. Number 17. Drying and preserving as capital accumulation. In the years before refrigeration reached rural Latin America, the family that had mastered food preservation was the family with a functional savings account. Dried beans kept for 2 years, dried chilies kept for 3, salt-cured meat kept for 6 months, fermented vegetables kept indefinitely, sun-dried fruit kept for a full year. A family in 1933 Boyaca that spent August and September systematically preserving the surplus of a good harvest was converting that surplus into stored calories, a form of capital that inflation could not touch, that banks could not seize, and that fed the family through the following year, regardless of what happened to prices or employment. The Depression made this practice not just prudent, but essential. Families that had not developed preservation skills before 1929 scrambled to learn them after. The knowledge passed faster than any school could have taught it because necessity is a more efficient instructor than curriculum. The grandmother who spent every August at the drying racks was not doing domestic work. She was managing the family's capital reserves. Number 16. The rotating labor pool. In Depression-era Latin America, when cash wages collapsed and formal employment disappeared, communities reorganized labor on a rotation basis that kept productivity high without requiring money to change hands. The principle was simple. Every family contributed labor days to a shared pool and drew from the same pool when they needed intensive work done: planting, harvesting, construction, repair. In 1932 Antioquia, a community of 30 families operating a rotating labor arrangement could mobilize the equivalent of 15 full workdays for any member who needed them, funded by the obligation to contribute 15 days across the coming year. No cash exchanged hands. The labor was the currency. This system had existed before the Depression under various names: the Minga in the Andes, the Tequio in Mexico, the Convite in Central America, but the Depression transformed it from a cultural tradition into an economic survival mechanism. Families that participated fully survived intact. Families that withdrew from communal labor arrangements because they thought they could manage alone discovered that individual survival in a collapsed economy is significantly harder than it looks from the outside. Number 15. The backyard pharmacy. Before pharmaceutical companies reached rural Latin America, and before most working families could afford commercial medicine, even where it was available, the household that maintained a working knowledge of medicinal plants was the household that kept its labor force healthy without cash expenditure. A sick worker in a Depression-era subsistence household was not just a personal tragedy, it was an economic crisis. The loss of one adult's labor for 2 weeks during harvest could cost a family a significant portion of its annual food supply. Families with plant medicine knowledge kept workers functional through illnesses that would have debilitated households dependent on commercial treatment. In 1935 rural Colombia, a woman who could treat fever with quinine bark, infections with garlic preparations, digestive problems with chamomile and mint, and respiratory illness with eucalyptus steam, had effectively eliminated the medical cost that was bankrupting urban working-class families trying to access commercial healthcare they could no longer afford. The Depression did not create this knowledge. It revealed its economic value by removing the commercial alternative. Here is where things get interesting. The methods above were about keeping what you had and staying alive. The ones below are about how Latin American families actually rebuilt during the Depression, how they moved from survival to recovery without waiting for the economy to fix itself, without government assistance, and without the formal banking system that had failed them. This is the part that economics textbooks skip because it contradicts the story that recovery requires institutions. Number 14. The Neighborhood Food Sharing Network. The single most effective poverty prevention mechanism in Depression-era Latin America was not a government program. It was the informal food circulation system that operated between neighboring households and that ensured that acute shortage in one family was absorbed by temporary surplus in others before anyone went hungry. The mechanism was simple and entirely social. A family that had extra food shared it without formal accounting, knowing that the obligation created would be honored when circumstances reversed. In 1,933 Mexico City's working-class neighborhoods, researchers documented that acute hunger was rare in densely networked communities and common in atomized households where families had lost their social connections. The network was not charity. It was a distributed insurance system where the premium was participation and the payout was food when you needed it. This system kept more Latin American families fed during the Depression than every government relief program on the continent combined. Not because governments did not try, but because neighborhood networks had information about who needed what, delivered to the right address, faster than any institution could manage. Number 13. Repairing everything. The Depression created the repair economy by necessity, and in doing so generated one of the most financially resilient household strategies in Latin American history. In a period when purchasing anything new was impossible for most families, the person who could repair a sewing machine, a plow, a saddle, a roof, a water pump, or a pair of shoes had an income stream that the Depression could not destroy because the Depression was itself generating the demand. In 1934 Bogotá, a skilled repairer working from a home workshop could earn more than a factory worker because factories were closing and repair shops were busier than ever. The skills required were technical but learnable. The capital required was minimal, a basic tool set, and the knowledge of how things worked mechanically. Families that invested in developing repair skills during the early Depression years were earning income by 1933 from demand that the economic collapse was directly creating. Your grandfather who could fix anything was not a handyman. He was running the only recession-proof business model available. Number 12. The barter circuit. As cash became scarce in Depression-era Latin America, communities rebuilt local economies on direct exchange of goods and services that had no need for money at all. The barter circuit that emerged was not the primitive pre-monetary system that economics textbooks describe. It was a sophisticated multi-party exchange network where value was tracked informally, obligations were remembered and honored, and the circuit moved goods from where they were surplus to where they were needed without any cash changing hands at any point. In 1931 Highland, Peru, anthropologists documented barter networks involving hundreds of families across dozens of villages that were moving food, labor, craft goods, seeds, and livestock in continuous circulation. The network survived the Depression intact. The cash economy around it collapsed. The families inside the network ate. The families outside it did not. The barter circuit was eventually displaced, not because it failed, but because the cash economy recovered and cash was more convenient than negotiating exchanges. The Depression proved that convenience is a luxury and that the ability to trade without money is a survival skill. Number 11. The communal childcare arrangement. In Depression-era Latin America, the two-parent household where both adults could engage in income-generating activity was dramatically more financially resilient than the household where one adult was consumed entirely by childcare. Communities solved this problem the same way they solved labor shortage and food shortage, through rotation and mutual obligation. In 1932 Mexico City, informal childcare sharing arrangements among groups of 6 to 10 neighboring families enabled both parents in each household to work, barter, or manage the household economy during the same hours, multiplying the productive capacity of each family by a factor that no individual household arrangement could match. The arrangement required trust, reliability, and the kind of deep neighborhood knowledge that comes from years of proximity. The Depression forced families into this interdependence, and in doing so created social infrastructure that persisted long after the economy recovered. The concept was not invented in 2015 and branded as a co-op nursery. Your grandmother's generation built it from necessity in 1932. Number 10. Selling knowledge door to door. In Depression-era Latin America, the person who understood something that others needed to know and who was willing to sell that knowledge in small, practical, affordable doses had an income stream that the Depression could not eliminate because the Depression was generating new problems every week that people needed to solve. A woman who knew how to preserve food taught preservation techniques for a meal or a small payment. A man who understood soil management sold planting advice to struggling farmers. A retired merchant who understood basic accounting charged neighborhood shopkeepers for bookkeeping help. In 1933, Medellin, informal knowledge sellers operated in every working-class neighborhood, offering practical instruction that no school provided and no institution organized because the need was too local and too specific for any formal system to address. The knowledge had zero production cost. It regenerated itself with each transaction. The only capital required was the expertise already stored in the person's memory. Your great-grandmother, who charged neighbors for what she knew, was running the most capital-efficient business model in economic history. Number 9. The urban garden. When formal food supply chains began breaking down in Latin American cities during the early Depression years, families with any outdoor space, a patio, a rooftop, a shared courtyard, converted it to food production. In 1931 Buenos Aires, municipal surveys documented that over 30% of working-class households were growing some portion of their own food in spaces that had previously been decorative or unused. The economics were straightforward. A family that produced 20% of its own food reduced its cash expenditure by 20% at a time when cash was becoming the scarcest resource in the economy. The most valuable crops were the ones with the fastest production cycle: lettuce in 30 days, radishes in 25, green onions in 45, beans in 60. Families that planted these in rotation had fresh food available continuously from a space as small as 4 square meters. The urban garden disappeared when supermarket distribution made purchased food cheaper than grown food. The Depression proved that this calculation is not permanent, and that the ability to grow food in an urban space is a skill worth maintaining regardless of current food prices. Number 8. The parallel currency system. This is the method that was declared illegal in 4 Latin American countries between 1932 and 1938, not because it was harmful, but because it worked. When cash became too scarce to sustain local commerce, communities in Mexico, Colombia, Peru, and Argentina began issuing their own local currencies, printed notes, stamped tokens, handwritten certificates, that represented claims on goods and services within a defined community, and that circulated as a medium of exchange among people who trusted each other enough to honor them. The economic effect was immediate. Commerce that had frozen because of cash scarcity resumed. Businesses that had closed reopened. Workers who had been idle began producing again. In 1933, Tlalpujahua, Michoacán, a community of 800 families that issued a local currency, restarted its local economy within weeks of the introduction. National governments shut these systems down specifically because they demonstrated that communities did not need the national currency to function, and a community that does not need the national currency does not need the national bank. Number 7. The extended family balance sheet. In Depression-era Latin America, the nuclear family was not the primary unit of economic survival. The extended family was the household that operated as an isolated economic unit, income in, expenses out, savings, if any, was dramatically more vulnerable than the household that understood itself as a node in a wider family network, where resources, labor, information, and obligations circulated continuously. In practice, this meant that a family with a working member in the city sent remittances to rural relatives who in turn sent food. A family with excess housing took in relatives who contributed labor. A family with knowledge of a market opportunity shared it with cousins who had the capital to act on it. The extended family balance sheet was never written down and never formalized. It existed in memory, in obligation, and in the understanding that what went around came around across a generation. The Depression stress-tested these networks and revealed which families had maintained them and which had allowed them to erode in the relative prosperity of the 1,920 seconds. The ones that had maintained them survived. The ones that had not wished they had. Number 6. The skill-stacking strategy. In Depression-era Latin America, the most financially resilient individuals were not the most specialized. They were the most versatile. The worker who could do one thing, operate a specific machine, perform a specific agricultural task, work in a specific industry, was devastated when that one thing stopped paying. The worker who could do 6 things across 6 different economic categories always had something that someone needed. A man who could farm, repair tools, treat animals, read well enough to write letters, drive a cart, and play music at celebrations had 6 income streams in 6 separate categories, none of which depended on the others. In 1932, when cotton prices collapsed in Colombia, the cotton workers who had no other skills lost everything. The cotton workers who had maintained other skills alongside their primary work had 5 remaining income streams the day the cotton market closed. The Depression revealed that skill stacking was not inefficiency. It was the most rational response to an economy that could remove any single income source without warning. Number 5. The strategic marriage alliance. This is the method that modern sensibility finds uncomfortable to discuss, but that Depression-era Latin American families treated as an economic decision as rational as any investment. Marriage in the 1,930 seconds was not primarily a romantic institution. It was an economic alliance between 2 family networks that doubled the resources, skills, labor, land, and social connections available to a household. Families that made strategic marriage choices during the Depression, matching skills rather than sentiments, land rather than looks, complementary family networks rather than similar backgrounds, built economic units that were dramatically more resilient than families that had not thought about marriage in these terms. A family with land but no mechanical skills that married into a family with mechanical skills but no land created a household that had both. A family with city connections that married into a family with rural food production created a household that could access both markets. Your great-grandparents who married for practical reasons understood something about household economics that the romantic model that replaced it chose to forget. Number 4. The knowledge emigrant network. One of the most powerful but least documented survival mechanisms of Depression-era Latin America was the information network maintained by family members who had emigrated to cities, to other regions, or to other countries, and who sent back not just money but intelligence. A family in rural Jalisco, with a son working in Mexico City in 1931, had access to information about urban prices, employment opportunities, and market conditions that their neighbors without city connections entirely lacked. This information had direct economic value. Knowing that a specific product was scarce in the city before anyone else in the village knew meant first-mover advantage in supplying it. The emigrant network was a distributed intelligence system that covered geography no individual family could monitor alone. The obligation to share what you knew with your network was as binding as the obligation to share food. Families that maintained active communication with dispersed relatives survived the Depression with better market intelligence than the commercial houses that were supposed to have it. Your family member who wrote letters from the city every week was not just staying in touch. They were running an intelligence operation. Number 3, the productive asset over the liquid asset. Depression-era Latin American families that came through the 1,930 seconds with their economic position intact shared one financial decision pattern that those who did not recover lacked. They consistently chose to hold productive assets over liquid assets. Cash disappeared in the Depression, either through deflation, bank failure, or hyperinflation, depending on the country. Land did not disappear. A sewing machine did not disappear. A set of carpentry tools did not disappear. A grinding mill did not disappear. Animals did not disappear. The family that converted its cash savings into productive assets before the Depression deepened had a factory in miniature that kept producing regardless of what happened to the currency. In 1929 Chile, the peso lost 40% of its value in 18 months. The family that held pesos lost 40% of its savings. The family that had converted pesos into a sewing machine, a small flock of chickens, and a seed reserve lost nothing because none of those things were denominated in pesos. Your great-grandfather, who spent money on tools and animals instead of saving it in the bank, was not imprudent. He was reading the economy correctly. Number 2, the debt-free household as strategic goal. In Depression-era Latin America, the single most important financial decision a family had made before 1929 was whether it carried debt. Families with debt were economically dead by 1932. Their land was seized, their tools were repossessed. Their labor was bonded to creditors who showed no flexibility because the creditors were themselves under pressure. Families without debt had options. They could plant or not plant, sell or not sell, work for wages or not, based on what made sense rather than what a debt payment schedule required. The Depression did not destroy these families. It gave them opportunities, because land and equipment were being sold by desperate debtors at prices that had no relationship to their productive value. In 1933 Cundinamarca, debt-free families with small cash reserves purchased land from bankrupt neighbors at 10% of its pre-depression value. By 1940, those purchases had made them among the most prosperous families in their municipalities. The Depression was the worst economic event of the century for families with debt. For debt-free families with even modest resources, it was the greatest wealth transfer opportunity in a generation. Number 1, the community that refused to let anyone fail alone. This is the method that no economics textbook includes because it cannot be quantified and no institution can replicate it and no company can sell it. The communities that survived the Depression in Latin America with their social fabric intact and their economic position preserved shared one characteristic that distinguished them from communities that fragmented under pressure. They had developed, over generations, a collective refusal to allow individual failure to become permanent. When a family lost its harvest, the community replaced the seed. When a family lost its house, the community rebuilt it. When a family lost its breadwinner, the community absorbed the dependents. Not out of charity, not out of government mandate, out of the understanding, developed over generations of living in proximity on the margins of a formal economy that had never reliably included them. That individual failure in their context was always one bad season away from any of them, and that the only insurance that actually paid out when you needed it was the community you had built before the crisis arrived. The Depression proved this beyond argument. The families that survived intact were not the richest or the most skilled or the best positioned. They were the ones most embedded in functioning community networks that had been maintained through years of ordinary reciprocity before the extraordinary moment arrived. Every other method on this list was more powerful inside a community that operated this way. Outside of one, most of them were just techniques. What your great-grandparents built was not an economy. It was a system for making sure that when the economy failed, and it always eventually fails, the people they loved would still be standing when it was over. That is not in any economics textbook. It probably should be.